Buckle up, because we're about to dive into the wild world of Bitcoin. It all started back in 2008, right after the financial crisis. Satoshi Nakamoto dropped a 9-page paper that would change everything. It was called Bitcoin, a peer-to-peer electronic cash system. This paper introduced Bitcoin, a revolutionary digital currency. It promised secure, transparent transactions without banks or governments. The secret sauce? Blockchain technology. A giant public ledger recording every Bitcoin transaction. On January 3, 2009, the first block was mined. This was the Genesis block, marking Bitcoin's birth. Embedded in this block was a message. The Times 03 Jan 2009 Chancellor on brink of second bailout for banks. A nod to the financial crisis that sparked Bitcoin's creation. In the beginning, Bitcoin was like that weird kid in school with a strange hobby that nobody understood. It was mostly tech-savvy programmers and cryptography enthusiasts who were tinkering with this new digital money. There were even stories of people buying pizza with Bitcoin, which sounds quaint now, but back then it was a major milestone. In May 2010, Laszlo Hanyecz bought 2 pizzas for 10,000 Bitcoin. Today, that amount would be worth millions, maybe even billions. Ouch! These early transactions were crucial for establishing trust and demonstrating Bitcoin's use as a medium of exchange. Bitcoin exchanges began to pop up, allowing people to buy and sell Bitcoin with traditional currencies. The price of Bitcoin was incredibly volatile, swinging wildly as more people joined the network. But through it all, the underlying technology continued to evolve and mature. As Bitcoin gained traction, it started attracting attention, and not always the good kind. Remember, we're talking about a decentralized system operating outside the traditional financial regulations. It was like the Wild West out there, with scammers and hackers lurking around every corner. One of the biggest blows to Bitcoin's early reputation was the Mt. Gox collapse in 2014. At the time, Mt. Gox was the largest Bitcoin exchange in the world, handling over 70% of all Bitcoin transactions. Then, disaster struck. It turned out that hackers had been siphoning off Bitcoin from Mt. Gox for years, and nobody had noticed. When the dust settled, over 850,000 Bitcoin, worth hundreds of millions of dollars at the time, had vanished. Poof! Gone! It was a devastating blow to the fledgling Bitcoin community, shaking confidence in the security and reliability of this new technology. The Mt. Gox debacle highlighted the need for stronger security measures, better regulation, and more robust infrastructure within the Bitcoin ecosystem. It was a painful lesson, but a necessary one. It forced the community to address vulnerabilities, improve security protocols, and build more resilient platforms. Section 4. The rise of Ethereum and the expanding crypto landscape. While Bitcoin was busy weathering storms and trying not to get hacked, another player emerged on the scene, ready to shake things up even further. In 2015, a young programmer named Vitalik Buterin introduced Ethereum, a platform that took blockchain technology beyond just digital currency. Ethereum was like Bitcoin 2.0, allowing developers to build decentralized applications, or dApps, on top of its blockchain. These dApps could be anything from games to prediction markets to complex financial instruments. It was a whole new world of possibilities, and it sparked an explosion of creativity and innovation in the crypto space. Suddenly, there were hundreds of new cryptocurrencies popping up, each with its own unique features and promises. Some, like Litecoin and Dogecoin, were designed to be faster or more efficient than Bitcoin. Others, like Ripple, targeted specific industries like cross-border payments. This period of rapid growth and experimentation became known as the altcoin boom. It was a time of incredible excitement and speculation, with investors pouring money into anything remotely related to blockchain technology. But just like the dot-com bubble of the late 90s, not all of these projects were built to last. Section 5. Bitcoin's bull run and the ICO frenzy of 2017. Hold on to your hats, folks, because things are about to get really wild. 2017 was the year Bitcoin went mainstream. The price skyrocketed, going from under $1,000 at the beginning of the year to nearly $20,000 by December. It was a wild ride, fueled by a frenzy of media attention, FOMO, fear of missing out, and a new fundraising phenomenon called ICOs. ICOs, or initial coin offerings, were like crowdfunding on steroids. Startups and projects could raise millions, even billions of dollars by issuing their own digital tokens. These tokens could then be traded on exchanges, often with little to no regulation or oversight. It was the Wild West all over again, only this time, everyone was invited to the party. The ICO craze attracted both legitimate projects and outright scams. There were stories of people remortgaging their homes to buy into the latest ICO, only to see their investments vanish overnight. It was a classic bubble, inflated by hype and speculation, and like all bubbles, it eventually burst. Section 6. Institutional embrace Tesla, MicroStrategy, and the floodgates open. After the 2017 bubble burst, the crypto market entered a period of relative calm, often referred to as the crypto winter. But behind the scenes, something significant was happening. Institutional investors, those big players with deep pockets, were starting to take notice. Companies like Tesla, Square, and MicroStrategy began adding Bitcoin to their balance sheets, viewing it as a hedge against inflation and a long-term store of value. This wave of institutional adoption brought with it a new level of legitimacy and credibility to the crypto market. Traditional financial institutions like Fidelity and Goldman Sachs also started offering Bitcoin-related services to their clients. It was becoming increasingly clear that Bitcoin was here to stay, and the financial world was starting to take notice. The introduction of Bitcoin ETFs, exchange-traded funds, in 2021 further fueled institutional adoption. ETFs allowed investors to gain exposure to Bitcoin without having to directly own or store the underlying asset. This made it easier for institutional investors to include Bitcoin in their portfolios, further legitimizing it as an investable asset class. Section 7. El Salvador's Bitcoin gamble and the quest for global adoption. In a move that shocked the world, El Salvador became the first country to adopt Bitcoin as legal tender in 2021. This bold experiment, spearheaded by the country's young and tech-savvy president, Nayib Bukele, aimed to promote financial inclusion and attract foreign investment. The move was met with a mix of excitement and skepticism. Supporters praised El Salvador for embracing innovation and challenging the status quo. Critics questioned the practicality of using a volatile cryptocurrency for everyday transactions and raised concerns about the potential for money laundering and other illicit activities. While El Salvador's Bitcoin experiment is still ongoing, it has undoubtedly put a spotlight on the potential for cryptocurrencies to disrupt traditional financial systems. Other countries, particularly in Latin America and Africa, are closely watching El Salvador's progress, exploring the possibility of adopting Bitcoin or other cryptocurrencies as legal tender. The quest for global adoption is one of the most exciting and challenging aspects of the Bitcoin story. It remains to be seen whether Bitcoin will become a widely accepted form of payment or remain primarily an investment asset.